we did speak about it a lot yesterday. So for now, we're just going to go quick. The session will not take too long because it's something that we've already looked at yesterday. So we're just going to focus on answering the questions and then we move on from that. Okay. The first thing we need to be aware of, we must not forget that the year end is 20th February 2025. And then we did say yesterday that it means it is starting on 1 March 2024, and then it is ending on 28th February 2025, right? And then we did look at the first 3.1, 3.1.2, 1.3. We did answer that. Now we're just moving straight to 3.2, okay? So now the question is based on liquidity for 3.2. So the question was saying the liquidity position of the company has improved, right? They are telling you that the liquidity position of the company has improved. Now they're saying quote 2 financial indicators with figures to support the statement, right? They only need 2 financial indicators. We don't need to explain a lot. They just want us to quote those 2 financial indicators. Okay, let me just go straight to the information. What can you say about that? Which 2 financial indicators that we can quote here indicating that there is an improvement in the liquidity?
The current ratio and the asset test ratio.
Okay, current ratio is showing an improvement. Let's see 0.3. Yes, to 1.6 to 1. That is an improvement. Asset test ratio, yes, it is also indicating an improvement here, even though it's not a big improvement, but there is an improvement here. So which means now I need to start. The first thing I can say that current ratio improved from where did it improve from? 0.3 is to 1 to 1.6 is to 1, right? 0.3 is to 1 in 2024, right? 2024 to 1.6 is to 1 in 2025. That is the improvement. 1.6 is to 1 in 2025. Okay, this is enough, ne? Anything else I need to state on top of this? I will do so. I think this is enough. We just needed to state the trend. Then the next one, you spoke about the acid test ratio. So let's look at the acid test ratio and see. Acid test ratio, it has improved from 0.1 is to 1 to 0.8 is to 1. So that's what we're going to say here. I'm going to say acid test ratio improved from where did it improve from? 0.1 is to 1 to 0.8 is to 1. Okay, 0.1 is to 1 to in 2020. I like to say the year, right? You write which year did it improve from. Okay, in 2024, 2, and then it improved to 0.8 is to 1 in 2025. Okay. That is the second one. So what was the question asking? The question was only asking about 2 financial indicators with figures to support the statement. So we did already pick 2, current ratio, acid test ratio. What about the other ones? Data collection period, does it indicate an improvement, this one?
Yes.
Yes, data collection period, it is also indicating an improvement. So you can also use it to answer the question where you can state that data collection period improved from, we can say that data collection period improved from how many days? Let's go and see. 63 days. No, 43 days to 36 days. Okay, 43 days in 2024 to 36 days in 2025. Okay, this is an improvement on debtors collection period. Okay, anything else? What about creditors payment period? Is there an improvement here?
No.
Yes, definitely not. There's no improvement on the creditors payment period. Any other financial indicator? I think we only have these that falls within the current ratio. There's no other one. So we can move on from the question. They only needed 2. You don't need to write 3. And there's nothing much you need to explain here. They only wanted you to quote, right? They only wanted you to quote the 2 financial indicators, right? They only wanted you to quote 2 financial indicators and we gave them 3. Okay. But now let's move on to 3.3. Dividend payout policy. They're saying here calculate the dividend payout rate for the year ended 28 February 2025. We did speak about this yesterday as well, where we're going to calculate the dividend payout rate. Which information did we say we're going to use to calculate that dividend payout rate? We still remember that?
The EPS over DPS times 100.
Earnings per share over dividends per share. No, not like that, but dividends per share over earnings per share. Ne?
Oh, okay.
Yes, we're taking dividends per share over earnings per share multiplied by 100. That's how we're going to do the calculation. So we're going to say dividends per share over earnings per share, and then we say multiply by 100, okay, which is going to be equal to dividends per share is 55, right? Dividends per share, we're having 55 over 51. So we're going to say 55 cents over 51, and then multiply by 100. Okay, so this is going to be our dividends payout rate. And then how much are we getting if we punch the calculator? How much are we getting?
I'm getting I don't think this number is like right. Getting 107.84. I don't think it does. Let me type it again.
You got 107.8, ne?
Yeah.
Yes,
I think
not
it's too high.
That is correct. That is correct.
Really?
Yes. It is possible to get something that is above 100%, ne? It is possible. The answer is 107.84, right? That's what you get from the calculator.
Yeah.
107.84%. This is a dividends payout rate. So it is possible to get something that is more than 100%, right? It is possible because, for example, if I'm gonna make an example, let's say your salary. Just wanna make an example for you. Let's say your salary this year. Maybe let me just say here. This is 2020. 2024, and then next year is 2025. Let's say your salary in 2024, let's say you were earning how much? 100 Rand, right? Let's say you're earning 100 Rand, and then next year you're earning 150. That is your salary. Your salary has increased by 50%. By saying that it has increased by half, 100, it has increased by half of these hundreds. That's why we're saying it is 150, right? If this was 100%, this is now 150%, right? But now, if your salary becomes 200, which means your salary has increased by 100%, because last year it was 100, now we added another 100%, now it is 200. If your salary increased to 300, it means your salary has increased by by how many percent? By 200%, for example. Because how are you going to calculate that? For example, if I say, for me to calculate the increase, I need to say 300 minus 100 all over 100, and then I multiply it by 100. Okay, so that's how I get the percentage, and then I say multiply by 100. So that's how I'm going to get the percentage. Then I say multiply by 100. So this is how I'm going to get the percentage. So if you can punch the calculator here, you will see that you will get something more than 100%. If you say 300 minus 100 over 100 times 100, you can see that we're getting how many percent? 200%, which means your salary has increased by 200% from 2024 to 2025. So it is possible to get something more than 100%. Don't be scared of that. Né? Must not feel like your answer was wrong if you're getting something like that. Am I right?
Yeah.
Okay, that is our dividends payout rate. It has increased, which means last year it was 60.3%. Now it has increased to 107.8. That is our dividends payout rate. So let's go back to the question here. The question was asking us to calculate the dividends payout rate for the year ended 28 February 2025. We did calculate it. We got it correct. Now, they're saying explain why directors decided to change the policy, right? Explain why directors decided to change the policy. Give one reason. You only need one reason why they decided to change the policy, because in 2025, you can see now compared to 2024, in these 2 years, last year they were paying a dividends payout. Dividends payout it was how many percent in the previous year? It was 60.3%, right? 60.3% in the previous year. But in the current year, it is now 107.84%, right? So now the question is asking you, explain why the directors decided to change the policy. Give one reason, right? Why the directors decided to increase dividends payout rate for shareholders. Why did they decide to increase? In other words, why would you increase the money that you're paying to your shareholders? Why would you increase the dividends? Because increasing a dividends payout rate, it means the dividends you're paying to shareholders are also increasing. Why would you increase a dividend that you're paying to your shareholders? What could be the reason for that? Anything you can say on that? What could be the reason for you? Let me just make it simple there. If, let's say, you own a company and you have people working for you, why would you increase their salaries?
If you're making more money as a company.
If you're making more money as a company, you can increase the salaries of your staff members, né?
Yeah.
Very good. Exactly. What other reason you can, why is there any other reason you can maybe say I'm increasing their salaries?
The only other reason for like increasing the salaries for like maybe directors is to like please them.
To please their,
If
yes,
your finances aren't looking good.
it's to please the directors, né?
Yeah.
Yes, you can increase the salary to please your workers, to please your directors, which means the same thing you can do for your shareholders. You can increase their dividends to please them, right?
Yeah.
Yes, it's something that, or to make them happy, right? They can increase the dividends payout rate to make the shareholders happy, or maybe by them being happy, which means they're going to keep their investment with us, right? They're not going to sell their shares and leave the company. You know what I'm talking about. So now it could be one of the reasons to please or maybe to encourage shareholders to keep their investment with the company. So we can issue more dividends. We can pay them more dividends to encourage them, right? To encourage shareholders to keep their investment, right? To keep their investment within the company, okay? So you can't do that because the more they withdraw their investment, it means the company is no longer, it means the company they will no longer have enough investment to carry on with operations. That could be one of the reasons. So they were, how many they were asking here, but there's a lot obviously we can talk about, right? They said give one reason, but there's a lot we can talk about, right? You can say that to please, right? Another thing, to pay more dividends, it's possible that there is more retained income that was kept in the previous years, and then that is being used to pay, right, to pay more dividends. So it is possible that the company is using the previous retained income to increase the dividends of the shareholders. That could be one of the reasons why we're going to increase their payment, to pay them more, because maybe we have too much retained income that has been used, right? So we can talk about that again, that the company has sufficient retained income to cover the increase in dividends, right? The company may have sufficient retained income to increase, to pay the increased dividends, right? Okay, dividends. So that could be one of the reasons, right? That could be one of the reasons. Another thing, when we're increasing the dividends, you can increase the dividends to attract external investment. Am I right on that? Can you not increase dividends to attract other people to come and invest in this company? Because if I know very well that Shoprite is paying more dividends, am I not going to be interested to go and invest in Shoprite?
Yeah.
Yes, definitely. So that could be one of the reasons as well, to attract more external investment, right? To attract more external investment. So that could be another reason to say, if I pay more dividends, I'm trying to make sure, even like the market price, because look, the more I attract external investment, the more I attract people to come and buy our shares, which means the market price for my shares will increase. If we go back to the information we analyzed yesterday, if you look yesterday, we were not happy that the market price was going down. Can you see the market price of the company's shares was going down from 1,030 cents per share to 1,000 cents per share, right? That is not something we should be happy about. So now, if we pay more dividends, we're going to attract more people from outside to buy our shares, which means now the demand will increase. If the demand increases, the market price also increase. So now it is possible that directors, they want to improve the market price of the company, right? The market share price of the company, the market price per share. It's possible they want to improve that, because you can look, if you can see that the market price is going down, which is not something we should be happy about. So you see, there's a lot of different reasons you can talk about, you know? There's a lot of different reasons we can talk about. But again, I'm just going to write these ones. They only needed one, then we can move on to 3.4. Okay? What is 3.4 saying? Now we're talking about percentage shareholding and repurchase decision making. Okay? So here they're saying, calculate the number of new shares that Denzel purchased on the 1 July 2024, right? I think we did talk about something like this yesterday. We did speak about something like this. Calculate the number of new shares that Denzel purchased on the 1 July 2024. The new shares. Okay, let's go and check. here they gave us the shareholding of Denzel, Cross Inverness Ltd, right? They did tell us that the percentage shareholding on 29 February 2024 was 45%, right? And the number of shares owned on 28 February 2025 was 494,000 rands. What did we say yesterday? For us to be able to know how many shares did they purchase, we need to know how many shares did they hold at the beginning of the year and how many shares are they holding now. We already have that information. The number of shares they're holding at current financial year end, we know that it is 494,000. But at the beginning of the year, how many shares? The guy was holding 45%. And then the total number of shares in 2024, it was 900,000. So how many shares? If you say 900,000 multiplied by 45%, how many shares did Denzel hold at that time? How many shares are we getting? $900,000 multiplied by 45%.
105,000.
105,000 rands. Very good. So now this means that Denzel Cross was holding in 2024. In 2024, the guy was holding how many shares? 2024, he was holding 405,000 number of shares. Okay, 405,000 shares. Okay, that is in 2020, in 2024. Okay, but now in 2025, how many shares is he holding? Let's see. 2025, he's holding how many shares? He's holding 494,000 shares. Okay, 494,000 shares. Okay, now from these two, then how many shares purchased now, right? Shares purchased. So how many shares were purchased by this guy, which means that is going to be the difference between the two. So which means now he purchased how many shares? Can't do that because if I say 405,000 minus 494,000 for how many shares? There is 89,000 shares that he purchased. Do you agree with me on that?
Yeah.
Yes, 89,000 shares were purchased. So that is the answer for question 3.4. Calculate the number of shares that Denzel purchased on the 1 July 2024. So for us to calculate that, obviously, we need to start by saying we need to show some workings because we can't just say give the value. So we need to start by saying 900,000 minus 45%, right? We need to say 900,000 multiplied by 45%. And then we're saying minus, right? And then we're saying minus 494,000. And that's when we're going to get 89,000 shares, okay? So these are the shares that were purchased based on the calculation that we are making. Are you following the calculation? You following it, no? Okay.
Yeah.
Okay, perfect. Then we can move to the next question. The next question was asking you, calculate Denzel's percentage shareholding on 28 February 2025. The percentage holding, which means now how many percent of the shares he was holding on the 28th of February 2025. So that's what we need to calculate. 28th February 2025, we know very well that how many shares did he have? He had 494,000 shares in 28th February 2025. Then out of the total, obviously for me, if I'm calculating that, I'm going to say 494,000 because he was holding 494,000. So I need to say divided by the total. How many shares were in issue on 28th February 2025? On 20th February 2025, how many shares are in issue? We have 950,000 shares. These are the shares that are in issue on 20th February 2025. So which means now I'm going to say 950,000 and then multiply by 100. Am I right on that? Times 100.
Yeah.
And then how many percent are we going to get?
52%.
We're getting the 52%. So this 52% is the percentage shareholding that Denzel was holding. Is the percentage shareholding of Denzel on 20th February 2025. Okay. Let's carry on. And number 3, the independent auditor discovered that Denzel had made the decision to repurchase the shares from the estate of the deceased relative, right? From the estate of the deceased relative on 1 December 2024 without informing the board of directors. Why should the independent auditor be concerned about this, right? Why should the independent auditor be concerned about this? Give one reason for the answer. Do you think is it the right thing for this guy because he bought the shares of the estate from the estate of deceased relative, which means now one of the family members or one of his relatives maybe died, and then he bought shares from that relative without notifying the other directors, right? Do you think is that a right thing for one of the directors to do?
No.
Why is it wrong? Why is it wrong not notifying other directors?
I think it is a requirement that they have to, like, all shares that are like issued have the shareholders have to be notified.
Yes, the shareholders have to be notified. Not really the shareholders, but directors, all of them, they need to know, right? Because
Yeah.
if you look here, they said this guy bought the shares without informing the board of directors. When we talk about the board of directors, we're talking about a number of directors. We talk about all directors of the company, right? Both executive and non-executive, which means if the company has 10 directors, all of them, they need to know about this, right? It is not allowed for Denzel to just buy back the shares, to just buy the shares of the company from his relative and then own those shares without notifying the other directors. It is not allowed. That is unfair because he is using confidential information, or he is using information that is available to him on his advantage, which is not right? It is unethical. Doing something like this, it is unethical. So the question was, why should the independent auditor be concerned about this? Give one reason for the answer. The reason you can just state here is that it is unethical for this guy, for Denzel, to use the information that was available, right? Or for taking advantage of the information that was available to him and use it on his advantage, right? It is really unethical, or it is unfair. It is unfair practice, right? It is unfair or unethical practice, right? Unethical practice for Denzel, right? To use the information that was available only to him. Information that was available only to him without on his advantage. For example, we can say on his advantage, right? So something like this needs to be discussed by all the directors of the company, right? They need to they need to do it. They need to be available in making a decision like this. All directors of the company, they need to be involved in making a decision like this. So for him to make this decision on his own, it is not allowed, right? It is not allowed for one director. So this is very wrong for, as an independent auditor, I should be concerned because it is wrong to do something like this, okay? Are you happy with the question so far? Are you still following?
Yeah.
Okay, perfect. Now let's go to 3.5. Now let's go to 3.5. Let's go to 3.5. They're saying here, gearing and risk. The directors of Venus Ltd want to expand the business by opening more branches in other provinces. Explain why you would recommend that they should not borrow more money. Quote 2 financial indicators with figures, right? We need to explain why we're recommending them not to borrow money, but we need to quote 2 financial indicators that will make us tell them that you guys must not borrow more money. So let's go to those financial indicators. What are those 2 financial indicators that we can quote here to say you guys must not borrow more money? Which one we spoke about yesterday?
The debt equity ratio, and then we can compare the return on average capital employed to the interest rate if it's there.
To the interest rate, yes. So definitely we're talking about debt equity ratio here. We talk about return on average capital employed. That's another financial indicator that we said we are going to quote. That's what we spoke about yesterday. And then, yes, definitely we spoke about what's interest on loans, right? Interest on loans. So let's talk about debt equity ratio. What is wrong with debt equity ratio? What did you say is wrong?
It has increased and the business is highly geared.
The business is highly geared. Yes, I can agree with you on that because the increase in this debt equity ratio is not good for the business, right? It is definitely not good for a business to say debt equity ratio has moved from 0.5 is to 1 to 0.8 is to 1. That one is not good. So that is the first financial indicator that we need to stay. This is not an improvement. We can say it is an increase, but doesn't mean that it has improved, or you can even say it has deteriorated, right? So debt equity ratio, that is the first one we're going to quote. That is 3.5 that we're looking at. So debt equity ratio has increased from 0.5 is to 1. Debt equity ratio has increased from 0.5 is to 1 in 2024, right? To 0.5 is to 1 in 2024 to 0.8 is to 1, right? To 0.8 is to 1 in 2025, okay? So this is the debt equity ratio that we're quoting. Number 2, we said we're going to quote a ROTE, right? Which is the return on average total capital employed, right? We spoke about that. What is happening with the return? Return has decreased from 9.5 to 8.2, which is not something that we should be happy about, right? ROTE has decreased from how many percent? 9.5 to 8.2, okay? 9.5% in 2024 to 8.2% in 2025, okay? There is a decrease. Now, we have quoted the 2 financial indicators here. We can even though interest on loan, this one is not a financial indicator, but it is just an interest on loan. The only thing we can use this one is to compare it with to say the return on average is less than what? Is less than the interest on loan, indicating that borrowing money is not helping us. It is not helping us because the return that we're getting is less than the interest that we're incurring. Because if you borrow money, you're going to pay 12% interest. But how much return you're getting? You're only getting 8.2. So what's the use of borrowing money if it cannot help you? You see? So that is the problem that we are having with this one. So let's get the explanation now. The explanation now, we're saying that we said, let's talk about debt equity ratio first. We said the company is becoming more reliant on what? On loans or debt to finance the operations of the company. That is not right, right? That is not right. It is the explanation now, because this question was not only requiring you to quote, it also needed you to explain. The directors of Venus Ltd wants to expand the business by opening one more branches in other provinces. Explain why you would recommend that they should not borrow more money. We needed to explain, and we quote 2 financial indicators. Already, 2 financial indicators are quoted already. Now, what we need to do, we need to explain now, right? So now the company is becoming more reliant on debt capital to finance its operations or to fund its operation. That's what we can talk about. The company is becoming more reliant, right? It's becoming more reliant on what? Reliant on loan or debt capital, okay? Debt capital to finance or to fund its operation. To fund its operations, okay? Is it wrong to become more reliant on debt? To say we're becoming more reliant on debt, that is not wrong. There's nothing wrong with that, to use debt. If it's good for the company, we can use it. But this one, it is wrong because of what? We spoke about the interest. The return on capital employed is less than, right? The return on capital employed is less than what? The interest on loan. That is the reason why we're saying it is wrong, right? The return on capital employed is less than, right? Let's talk about the return. How many percent was the return in the current financial year? 8.2, right? The return on capital employed, 8.2%. I can quote the 8.2% here. Okay, and say is less than what? Interest on loan, right? Is less than interest on loan of how much? Of 12%. We spoke about this. So this indicates that we're not getting benefit from borrowing money. So let's rather leave it. We don't need to borrow money anymore, because how can you pay 12% interest but you're generating 8.2? That is not right. It's like you're running a business. You spend 500 to buy stock, but from that 500 you use to purchase your stock, you're only generating 400 from that stock. Is there, does it make sense for you to carry on with that business? It doesn't make sense. I cannot take my 500, my last 500 that I have, I go and buy stock to sell. And when I'm selling that stock, I'm only getting 400. I'm making a loss. Why am I still continuing with the business that is making a loss for me? Same thing, borrowing loans does not help us. So why do we continue borrowing loans? So we're not advising this company to carry on borrowing loans because it doesn't help them. So the advice we have for them is to stop borrowing money. They can do other things, try other ways, source of funding, but they must stop borrowing money. The other option of financing the proposed expansion is to issue more shares. The other option of financing the proposed expansion is to issue more shares. Explain how this will benefit the company. Provide 2 points. The other option of financing the proposed expansion is to issue more shares. Explain how this will benefit the company. Provide 2 points. Issuing more shares is good for the company, right? It is, or maybe it is better than borrowing money. Why are we saying it is good? How is it going to benefit the company? Anything you can say on this one, Kineva?
Or bring in finances and mm, it won't have like a much of it won't have the same effect as borrowing a loan where you have to pay it back. It's just quick money and you can quickly finance what you need to.
So the first point I'm hearing for you, no need to pay it back, right?
Yeah.
No need to pay it back to pay it back. So that is the reason. It's one of the advantages of issuing shares rather than borrowing money. Okay, no need to pay it back. That is a very good reason. What else are we avoiding if we issue shares rather than borrowing money? What else are we avoiding? Are we going to pay interest if we issue shares?
No.
So we no need to pay interest. Am I right on that? So interest expense will be avoided. Am I right if I'm saying that? Will be avoided. Okay. That is they wanted 2 reasons. The other option of financing proposed expenses to issue more shares. Explain how this will benefit the company. It will benefit the company because we're not going to be paying interest. We're not going to be paying interest. We're not paying back the loan. The money that we got from shareholders, we're not going to pay it back, right? Another thing we can talk about, because our debt equity ratio is like this, it is going to improve. If we issue more shares, this will improve, right? The debt equity ratio will improve if we issue more shares. So that it's something that we can talk about, right? Debt equity ratio will improve. Okay, a debt equity ratio will improve if we do this. So this is something that we should talk about, right? This is something that we should talk about. These are some of the advantages of doing what? Of issuing shares. Even though issuing shares, it does also have some other disadvantages, of which but it has more advantages than disadvantages. So we should not focus on something that is not going to help us. Share value, 3.6 now. Explain why shareholders should not be satisfied with the share prices of the company at the end of the financial year. Quote 2 relevant financial indicators and other related data. Why they should not be satisfied with the share price of the company? Why are they not happy? Let's go and check. When we spoke about the share price yesterday, which financial indicators we talked about yesterday when we're talking about the share price?
Net asset value per share and EPS.
We spoke about the net asset value per share. What is happening with the net asset value per share?
It's decreased.
The net asset value per share, it is decreasing. Yes, it's a bad thing for a company, right? It is a bad thing for a company if the net asset value per share is decreasing. So this net asset value, it has decreased from 1,060. So that's some first thing that we can talk about. Which question are we answering here? 3.6. Okay. Net asset value per share decreased from how many shares? From how much? 1,060 cents to 1,025 cents, right? 1,060 cents in 2024 to how many cents? To 1,025, to 1,025 cents, okay? In 2020, in 2025. It's not a good thing if the net asset value, if the net asset value per share is decreasing, that is a bad thing for a company. That is because the value of the shares that we're holding, they're going down. If the value of the shares is going down, it means the company is going down. Sorry, it's not a value of the shares, but it's a net asset value. Remember, what is a net asset value? Net asset value, if the net asset value is decreasing, which means the company is closer to liquidation. The company is going closer to the assets not being enough to cover the short-term debt. Remember, a net asset value. Net asset value is equal to asset minus liabilities is equal to net asset, right? Asset minus liabilities, okay, is equal to net asset, okay, is equal to net asset value, right? So if I have 5,000 assets and then I have how much liabilities, and I have maybe 3,000 liabilities. So my net asset value is going to be how much? 5,000 minus 3,000. You see? And then I'm having 2,000. If my net asset value is going down to 1,000, what am I doing now? Sorry. If my net asset value is going down to 1,000, which means what has changed here? What has changed here? It's possible that my liabilities has increased. I'm having 5,000 here, and then I'm having liabilities of 4,000 now. Can you see? My liabilities are increasing. If my net asset value becomes zero, which means I have 5,000 assets, I have 5,000 liabilities, which means now the net asset value is now zero of the company. It becomes a problem. If it carries on like that, we may end up having minus 2,000 net asset value, where we're having 5,000 assets, maybe 7,000 liabilities. The company is gone. Once it starts to reach this point, the company is gone because you have more liabilities than your asset. Your solvency ratio will become negative now. You see? So that is something that we're talking about here. But if we're saying the net asset value per share decreased from 1,060 to 1,025, it's becoming bad if the net asset value per share is decreasing. Okay? Now, we go back. The next thing that we spoke about is the market price. What did we say about the market price? Or you spoke about earnings per share, right? You spoke about the earnings per share. What is wrong with earnings per share?
Has decreased from 58 to 51 cents.
Yes, definitely. Earnings per share has decreased, but I want us to go back to the question so that we can see what was the question saying. Explain why shareholders should not be satisfied with the share price of the company at the end of the financial year. Okay, put two financial indicators and other relevant data. Okay, so if we quote the earnings per share, how does earnings per share affect the share price? How does earnings per share affect the share price? I don't want us to quote the earnings per share. It is not really relevant for this one, but the market price instead. The market price instead is the one that I want us to quote here. I want us to quote the net asset value per share. It's correct, we quoted it. The market price is declining, right? And even if you look at this, you see the value of the shares is 1,025, but we can only sell them at 1,000. So we're making a loss. You see, that is another problem we have in this company. The value of the share, the net asset value is 1,025 cents, but we can only sell those shares at a market price of 1,000 rand, of which we're making a loss. That is a problem. So the market price per share decreased from 1,030 to 1,000. cents, which is a problem. So that is another market price per share decreased from 1,030 cents per share to they said 1,030 cents per share to 1,000 cents, right? To 1,000 cents per share. Okay. This is like the two financial indicators that they were talking about when they said quote two relevant financial indicators and other relevant data. But we need to explain now why the shareholder should not be satisfied with the share price of the company at the end of the financial year, with the share prices of the company at the end of the financial year. We already spoken about that to say the share price, you can see now that the share price is 1,000, but the value of the share is 1,025. We should not be happy about this one. We're losing money. Instead of selling this thing with 1,025, but we can only sell them at 1,000. So which means there's a loss of about 25 cents that we're going to, there will be a loss of 25 cents here, right? So that is the explanation we can give here to say, when they say explain why shareholders should not be satisfied with the share price to the company at the end of the financial year. The company will incur loss of 25 cents, right? The company will incur a loss of 25 cents as what? As the net asset value, that is the NAV, is 1,025 cents, while is 1,025 cents, while the market share price is 1,000 cents. You see, we're going to make a loss here, whether we like it or not, by selling our shares. If we sell the shares, we're going to make a loss because the value of the shares is higher than the price. So what are we going to do? That is definitely going to be, it is going to be a loss for us. Okay. Are you following? Can we move on now to the next question?
Yeah.
Renewal of the CFO's contract. They said here, explain one reason why any company should appoint a suitably qualified person as their CFO, Chief Financial Officer. Why? Like, this is not just important for CFO only, but anyone. If you are running a company, you are appointing people to do the work. Those people, they must be qualified, right? They must be able to do the work that you have them for. So why is it important for you to hire or to appoint a qualified CFO?
Because they're doing the daily running of the business and they are responsible for the financial statements.
They're responsible for financial statements. That's correct, right? For the company to prepare the accurate financial statements, they need a qualified CFO, right? That answer is correct. The financial matters of the company. CFO is the person who's going to handle the financial matters of the company. So now, it is important to appoint a qualified CFO because he or she is going to handle the financial matters of the company. Any other reason, any other thing you can say?
I can't think of any other reasons.
Okay, no problem. But it's something like, for example, this thing is like a teacher. Why must we hire a qualified teacher to teach you? You understand? If a teacher for a math is coming at your school, why is your school supposed to hire a qualified teacher to teach you?
So that you can learn the proper information correctly.
Exactly, so that they can learn proper information. Those people, they're going to grow a young future from you. So they need to make sure that the school needs to make sure that they do proper research and hire people who are qualified to come and teach. The sustainability of the education for that school depends on those teachers, right? Same thing with the financial sustainability of the company. It depends on the CFO. So that is another reason. If the school, the goals of the school, if the school wants to be one of the high achiever school or one of the top achievers school in your area, they must hire qualified teachers, right? Same with the company. If we want to be one of the respected companies, right? One of the respected companies that are running smoothly, we need to hire a qualified CFO. So you can say there's a lot of things that you can say, but I will stop here for now. I'm not going to type this one. Let's look at the last bullet. Apart from the factors and financial indicators covered in question 3.2 to 3.6, quote and explain two financial indicators why you feel that Denzel contract should not be renewed. Two financial indicators why we feel that Denzel contract should not be renewed, which means now we need to check those financial indicators that are not maybe in a good condition for the company, not in a good position, but except those that we have already covered before. Any other financial indicators that we can talk about? For example, let me remove the ones that we have already spoken about. We did speak about current ratio, asset test ratio, data collection. We did speak about this, right? Creditors payment period, it was part of the liquidity, even though we did not quote it. Solvency ratio, did we speak about the solvency ratio anywhere before this? No, we didn't use solvency ratio. Debt equity ratio and ROTCE return, we did answer question with these ones. Net asset value per share, I think we did answer a question using this one. Dividends payout rate, dividends per share, earnings per share, dividends per share, dividends payout rate, we did speak about these ones. In terms of the earnings per share, we did not. Return on average shareholders equity, we did not. So from these 1, 2, 3, 4, which financial indicators makes you believe that we should fire the CFO?
Earnings per share and return on shareholders equity.
Earnings per share, it was 58 cents. Now it is 51 cents. Definitely, I can use this one. Return on average shareholders equity 6.2 to 4.5. It declined, right? I can use this one as well. Solvency ratio, can I use it?
You can, but you still can like pay off your debts.
Exactly. You can still be able to cover your debt using your total assets, but there is a decline, right? Which means it is not going in the right direction, even though we can still meet the short-term obligations, but it is not going in the right direction. So I can also use it to fire the CFO as well. Operating expenses on sales. Can I use it?
Oh,
Why not?
I think it's an improvement because you're not spending as much compared to 2024.
Exactly, very good on that, Kinelo. This one is an improvement because we are able to control our expenses, right? So they reduced, they went down from 22 to 18, which is a positive result for the company. So I can only use these three: solvency, return, ROCE, and then earnings per share. These are the financial indicators that we can use to fire there. So they wanted us to quote, apart from the factors, they said explain two financial indicators why you feel there's a contract. So those are the two that we can use. How are you feeling about the question overall?
Good.
Okay. You see, what is more important here is for you to be able to analyze